Hello everyone, I'm pleased to introduce our project, Abdex Blockchain, decentralized stablecoin based on risk exposure control and order book exchange with depth enhancement. We will divide the explanation into several sections: project track and market, Abdex decentralized stablecoins, Abdex decentralized order book exchange with depth enhancement, profit model and token empowerment, and future plans. Section 1, project track. Abdex targets three tracks in the blockchain industry: stablecoins, exchanges, and RWA real-world assets. First is the stablecoin. Stablecoins provide the service of pegging fiat currency prices on the blockchain. This is a huge market, and the current market value of stablecoins has reached $150 billion. Among them, the centralized stablecoin USDT is issued by the company Tether, which had a net profit of $6.3 billion in 2023. The MakerDAO protocol, which issues the decentralized stablecoin DAI, has an estimated net income of $220 million. It can be seen that the current market is mainly dominated by centralized stablecoins. Cryptocurrency exchange may be the most valuable track in the blockchain field. CZ, the richest Chinese, is the founder of Binance Exchange. Currently, the publicly available information is for Nasdaq-listed Coinbase Exchange. According to the financial report, its 2023 net profit was $950 million. The trading volume of Binance is about 10 times that of Coinbase, with an estimated net profit of over $10 billion. In decentralized exchanges, the profits of Curve Protocol and DYDX are estimated to be around $100 million. It can be seen that in the exchange track, centralized exchanges still dominate. RWA, or real-world assets, is the process of mapping tangible assets from real life, such as U.S. Treasury bonds, stocks, and gold, onto the blockchain, allowing them to exist and be traded in the form of cryptocurrencies. RWA is recently popular in the blockchain industry, but it is still in its early stages and has a relatively small market size. It is estimated that the total market size of RWA is approximately $9 billion. The logic of RWA is inherently difficult to decentralize, which is why all the current RWA projects in the market are centralized. However, Abdex has achieved a fully decentralized RWA through innovative design. Decentralization is of utmost importance. We know that blockchain technology originated from the Bitcoin network proposed in 2008, featuring decentralization, immutability, transparency, and security. Using decentralized services is also the demand of the vast majority of blockchain users. Centralized services have a series of problems. Centralized stablecoins like USDC and USDT have experienced multiple instances of price depegging and freezing of user assets. Centralized cryptocurrency exchanges lack transparency and are often accused of price manipulation and misappropriation of funds. The FTX exchange's bankruptcy highlighted the severity of these issues. Recently, Binance and OKX exchanges have also been exposed to security problems involving the theft of user assets. These aforementioned problems are precisely what blockchain technology is inherently capable of solving. However, it is ironic that even in the realm of blockchain and cryptocurrencies, renowned for decentralization, the majority or even all of the crucial infrastructure, such as stablecoins, exchanges, and RWA, is centralized. The reason behind this is that decentralized services in these areas have flaws in functionality and lack competitiveness. Abdex is dedicated to addressing these issues. Abdex has made innovations and breakthroughs in all three tracks, realizing fully decentralized stablecoins, order book exchanges, and RWA. This allows cryptocurrency holders to trade and diversify their investment portfolios globally in a completely decentralized manner. Section 2. Abdex Decentralized Stablecoin. Let's start by talking about centralized stablecoins. The mechanism of centralized stablecoins is: centralized institution receives users' dollars, then issue the corresponding amount of stablecoins to users on the blockchain. Essentially, the issuing entity has the power to freeze and penalize any on-chain account, and users cannot guarantee the safety of their assets. Even if the issuing institution does not act maliciously, Silicon Valley Bank bankruptcy event tells us, even the most regulated and transparent centralized stablecoin USDC can potentially lose all your assets. The situation with the largest stablecoin, USDT, may be even worse, as expressed in this meme image. USDT's biggest advantage, apart from its first mover advantage, is its lack of transparency. This means that USDT may be less susceptible to negative information because no one knows what they are actually doing. However, when internal problems truly occur, the consequences could be even more severe, as users may not even have a chance to escape. In contrast, the security of decentralized stablecoins is determined by code, which is immutable and inherently transparent, allowing anyone to monitor the stablecoin account on the blockchain. These advantages precisely compensate for the shortcomings of centralized stablecoins. However, the existing decentralized stablecoins all have obvious shortcomings. Apart from algorithmic stablecoins, which have been proven infeasible, the two current leaders in decentralized stablecoins are both over-collateralized stablecoins, namely DAI from the MakerDAO protocol and LUSD from the Liquidity protocol. Over-collateralized stablecoins are often referred to as lending protocols, allow users to over-collateralize their cryptocurrencies and borrow stablecoins created by the protocol. This enables users to obtain tradable liquid assets while retaining the potential for their cryptocurrencies to appreciate in value. For over-collateralized stablecoins, there are two major challenges. Firstly, how to maintain the peg, and secondly, how to handle liquidations. Let's first examine how centralized stablecoins peg their value to the US dollar. The principle is arbitrage between primary and secondary markets. The primary market for centralized stablecoins is where users can exchange stablecoins and US dollars with the issuer at the pegged price, meaning 1 USDT on-chain can be exchanged for 1 US dollar off-chain and vice versa. The secondary market is the market where stablecoins are traded, and the goal of the peg is to maintain the pegged price in the secondary market. Assume that when the price of USDT in the secondary market is $0.9, arbitrageurs can buy USDT in the secondary market and then exchange it for $1 from the issuer in the primary market, thereby obtaining a risk-free profit of $0.1. This behavior of purchasing USDT in the secondary market will drive up its price in the secondary market, ultimately converging back to $1. Conversely, when the price of USDT in the secondary market is $1.1, arbitrageurs can exchange $1 for 1 USDT from the issuer and sell it in the secondary market at a price of $1.1, thereby pushing down the price of USDT in the secondary market. The arbitrageurs also obtain a risk-free profit of $0.1 in this case. In blockchain, the above process is also known as the hard pegging of stablecoins. However, for over-collateralized stablecoins, the above process is not feasible. Taking MakerDAO's DAI as an example, when the secondary market price is $1.1, due to the existence of over-collateralization, if you collateralize $1 worth of crypto assets, you can only obtain 0.67 DAI. When the arbitrageur sells these 0.67 DAI at $1.1, they still haven't completed the transaction and made a profit because they still have $1 of crypto assets locked in the primary market collateral. To complete the transaction, the only thing the arbitrageur can do is wait for the price of DAI to decrease in the secondary market, and then buy back the previously sold 0.67 DAI at a lower price to unlock their collateralized assets in the primary market. This process is not risk-free like the previous arbitrage. The arbitrageur will face risks such as the price of DAI not falling, the collateralized assets being liquidated, and the cost of borrowing interest. In this transaction, the arbitrageur has a chance of facing huge losses. When the price of DAI is $0.9, this sort of arbitrage becomes even more difficult because only users who have previously collateralized and borrowed can burn DAI in the primary market to redeem their collateral. These factors greatly limit arbitrage behavior and affect the pegging of stablecoin prices. Due to the inability to hard peg, MakerDAO initially opted for soft pegging, which involves adjusting the supply and demand relationship of stablecoins through borrowing rates to stabilize coin prices. However, this approach has proven to be unfeasible. As a result, MakerDAO had no choice but to introduce the PEG stability module, which allows users to deposit centralized stablecoins into the protocol in exchange for DAI, and also allows users to exchange DAI for the centralized stablecoins collateralized in the protocol. Through this method, the hard pegging of stablecoins is achieved. However, this brings about two issues. First, centralized stablecoins only account for a portion of the protocol pool, which means that the hard pegging arbitrage process cannot cover all the issued DAI. On the other hand, for the decentralized stablecoin DAI, more than 50% of its asset pool consists of centralized stablecoins. Therefore, its value and security also rely on centralized stablecoins, making DAI essentially a centralized decentralized stablecoin. Another prominent decentralized stablecoin is LUSD of Liquidity Protocol, which sets an extremely low collateral ratio of 110%. According to the hard pegging principle, the Liquidity Protocol sacrifices the security of liquidation to hard peg the upper limit of the stablecoin LUSD price at $1.1. The bigger issue is how to peg the lower limit of the stablecoin. The design of the Liquidity Protocol is that once the price of the stablecoin falls below $1, users who have not collateralized can also send one stablecoin to the protocol in exchange for $1 worth of collateral, thus achieving a hard peg of the lower limit. However, this means that the protocol needs to forcibly liquidate borrowers who should not be liquidated. In other words, for borrowers, even if your collateral is sufficient, you may still face liquidation. This process is premised on sacrificing the security of borrowers' funds. The Liquidity Protocol has made provisions for the liquidation order of borrowers. The lower the collateral ratio, the higher the priority for liquidation. This has led to a collateral ratio race among borrowers, with users maintaining very high collateral ratios, significantly reducing capital efficiency and losing the meaning of borrowing. Justin Sun was almost liquidated due to this mechanism, with $6.4 billion in collateral positions. Overall, the two leading decentralized stablecoins have not effectively resolved the issues of price stability and liquidation challenge. DAI has chosen to sacrifice decentralization, while LUSD has chosen to sacrifice borrowers' rights and application scenarios. This has led to their inability to successfully expand, putting them at a disadvantage when competing with centralized stablecoins. Abdex stablecoin resolves the issue of price pegging by controlling risk exposure. When the secondary market price of the stablecoin is too high, such as $1.1, it triggers an on-chain active arbitrage mechanism between the primary and secondary markets. The stablecoin system first mints stablecoins, sells them on the secondary market at $1.1 to obtain ETH, and then shorts the same amount of ETH on the on-chain derivatives market for hedging. In this process, the stablecoin system not only stabilizes the coin price, but also achieves a 10% yield. Conversely, when the stablecoin price is $0.9, the stablecoin system will withdraw ETH worth $0.9 from its module account, then buy back stablecoins at a lower price and burn them. If this is the only action taken, the stablecoin system will incur debt when the ETH price rises later. This is because the withdrawn ETH is pledged by users, but now it has been exchanged for USD, leaving the system with insufficient ETH to return to users. Therefore, the stablecoin system should match the risk exposure of this $0.9 worth of ETH, and long these ETH in the derivatives market, keeping the overall risk exposure unchanged. It is important to note that the realization of derivatives positions here will not suffer from liquidity issues. During the process of preventing the coin price from being too low, the system buys back and burns stablecoins, ensuring that when users want to redeem their collateral, the circulating stablecoins in the market must be less than the stablecoins they borrowed. Furthermore, this implies that to redeem all the collateral, the arbitrage mechanism triggered by high stablecoin prices must be activated to increase the circulating stablecoins in the market. At this point, the stablecoin price will certainly be at a high level, and the arbitrage mechanism for excessively high stablecoin prices will prompt the stablecoin system to short ETH, gradually closing the previous long positions. Another issue that needs to be considered with over-collateralized stablecoins is how the protocol liquidates borrowers' collateral when they touch the liquidation rate. In principle, this process should involve selling the collateral to be liquidated on the market, buying back the issued stablecoins, and burning them. However, this process implies a liquidity problem because there may not be enough stablecoins in the secondary market for the protocol to buy back. This means that the protocol may bear significant floating losses due to the substantial depreciation of the collateral from being unable to liquidate, or it may have to buy back stablecoins at much higher than normal prices, resulting in realized losses. The more application scenarios and the more dispersed the liquidity of the stablecoin, the more likely this situation is to occur. During the DAI 312 Black Swan incident in 2020, the protocol faced significant debt due to difficulties in liquidation caused by liquidity issues. Abdex does not operate in this way. When liquidating, Abdex does not purchase stablecoins on the secondary market. Instead, it directly shorts the corresponding value of positions in the derivatives market. By using BTC and ETH as margin instead of stablecoins, Abdex avoids the difficulties in liquidation caused by insufficient stablecoin liquidity. In summary, Abdex addresses the issues of price stability and liquidation challenge through risk control. It also offers three ways to obtain stablecoins: lending in primary market, purchasing in secondary market, and purchase in secondary market triggers issuance in primary market, making stablecoins easier spread. At the same time, by utilizing the characteristics of over-collateralization, Abdex can achieve lossless conversion of stablecoins and create global stablecoin. Abdex stablecoins support two sort of cryptocurrencies as collateral, BTC and ETH, and can generate stablecoins pegged to any fiat currency. Due to over-collateralization, it is only necessary to ensure that the face value of the borrowed stablecoins is lower than the face value of the collateral. Therefore, lossless conversion of foreign exchange between different stablecoins can be achieved. For example, assuming the ETH price is $2,000 and the euro price is $2, if a user pledges 1 ETH and borrows 1,000 USDA, when the user needs the euro stablecoin EURA, they can apply to the Abdex stablecoin system. Abdex will burn the received 1,000 USDA, mint 500 EURA, and send them to the user. Abdex stablecoins can be pegged to any price provided by Oracle. Therefore, in addition to tracking the US dollar, euro, and yen, the stablecoin system can also track the weighted price index of various fiat currencies, thus achieving a global currency stablecoin, GLBA. In general, Abdex stablecoins have the following characteristics: fully decentralized, lossless foreign exchange conversion, multiple fate stablecoins, and global currency stablecoin. Section 3. Abdex Depth-Enhanced Decentralized Order Book Exchange. Currently, most decentralized exchanges operate on virtual machine public chains like Ethereum. Limited by the computing power and storage resources of the public chain, these decentralized applications have extremely low operating efficiency and struggle to implement complex financial logic, such as order book exchanges. As a result, they can only use compromised solutions like the AMM model, making it difficult to achieve the same user experience as centralized exchanges. Another issue brought about by limited computing resources is the high cost. On Ethereum, even the simplest transfer usually requires a fee of around $4. These problems make it challenging for decentralized exchanges to gain a competitive advantage over centralized exchanges. Abdex chooses to build its own app chain using the Cosmos SDK instead of using a public chain. An app chain is a blockchain designed specifically for a particular decentralized application. It can solve the computational efficiency and cost issues of public chains through customization and optimization, thus enabling the implementation of complex order book spot and derivatives exchanges on the blockchain. Abdex Exchange and Abdex stablecoin system are complementary. The exchange provides hedging liquidity for the stablecoin system while also offering application scenarios for Abdex stablecoins. Furthermore, integrating the stablecoin and exchange on a single chain and making the interaction between the two as blockchain consensus can resolve potential congestion issues on public chains, greatly enhancing security. Currently, the biggest competitor Abdex faces in the decentralized order book exchange field is DYDX, which was founded in 2017. To achieve a certain degree of decentralization, DYDX recently launched its version 4, also using the Cosmos SDK that's chosen by Abdex for development. At this stage, the development of Abdex has already overcome all the core technical challenges, giving Abdex order book trading system several advantages compared to DYDX. 1. Abdex has achieved complete on-chain matching, with the entire system running decentralized on-chain. In contrast, DYDX's order book is matched off-chain. 2. Abdex supports multiple currencies for paying gas fees, which means users do not need to exchange native tokens to pay gas fees, greatly improving the user experience. 3. Abdex is a complete exchange supporting spot, perpetual contracts, and futures, as well as multi-currency and mixed margin trading. On the other hand, DYDX only supports perpetual contract trading with USDC as margin. 4. Due to the innovative design of on-chain market making and market making order, Abdex can have more abundant liquidity while realizing stablecoins and RWA functionality, which DYDX does not possess. Liquidity in the exchange is crucial for both the order book exchange itself and the security of the stablecoin system. Abdex Exchange introduces two major mechanisms, on-chain AS market making and market making orders, to ensure liquidity in the order book market. Market making is the fundamental way to provide liquidity for the order book market. Market makers place limit orders on both the buy and sell sides around the mid price to capture the spread while improving the liquidity of the order book. To increase market liquidity, Abdex innovatively makes the classic AS market making algorithm on-chain. Any user can participate in on-chain market making by staking. Moreover, to encourage users to provide liquidity to the order book, Abdex offers a share of transaction fees for on-chain AS market making. Compared to AM, the AS order book market making algorithm we use can better control inventory risk, which is the impermanent loss in AMM. At the same time, the fund efficiency is higher, resulting in higher market-making return. Another innovation by Abdex to enhance liquidity is market-making order. Market-making requires a lot of limit order submissions and cancellations, and the gas fees required for blockchain transactions can significantly increase the cost of market-making, which in turn affects the liquidity of the order book. The purpose of market-making order is to facilitate market making for market makers. Market making order is defined as a limit order placed within the effective price range that will be automatically canceled by the blockchain within a single block, do not incur gas fees or trading fees. Any user can stake cryptocurrencies to obtain the effective market making volume required for market making orders. By penalizing users who do not meet the effective market making volume and imposing price restrictions on market-making orders, the system can serve genuine market makers, improve the liquidity of the order book, and also avoid the possibility of hackers using market-making orders for DDoS attacks. Here's an example of market-making order application scenario. Suppose there are two market orders, one to buy 100 units and another to sell 200 units. By placing market-making orders at the two best limit prices, it is possible to profit from the bid-ask spread without risk. Market-making order can benefit all three parties. For the system, it reduces the consumption of the on-chain AS market-making algorithm and ensures market liquidity. For traders, it reduces the slippage of their trades. For market-making users, they can obtain risk-free returns, thus providing motivation to place market-making orders. Another application of market-making order is to achieve decentralized RWA. Going back to the previous example, can the market maker not profit from the remaining 100 units of sell orders? They still can. Typically, centralized exchanges have better liquidity, resulting in tighter spreads. Suppose Abdex has a larger spread. In that case, the market maker can place another market-making order to fill this market order, while simultaneously placing a reverse market sell order on the centralized exchange to profit. Essentially, this involves placing a market order on the centralized exchange and a limit order on Abdex, effectively transferring liquidity from the centralized exchange to decentralized exchange Abdex, thus also known as liquidity arbitrage. Furthermore, if we replace the centralized exchange, where the market order is placed, with a traditional financial exchange, it means we can transfer liquidity from traditional financial trading to the blockchain, enabling the interconnection between off-chain assets and on-chain assets. This provides Abdex with more trading varieties and helps diversify the correlation of users' portfolio. Cryptocurrency holders have the opportunity to directly invest on-chain to gain risk exposure to indices, commodities, and even bonds from various countries, realizing truly decentralized RWA. Abdex can also realize on-chain ETF. The price of ETF in the secondary market can be linked to the value of the underlying assets of the fund, relying on the primary and secondary market arbitrage mentioned above. Arbitrageurs can purchase the underlying assets and provide them to the fund issuer to obtain ETF shares, or they can exchange ETF shares with the fund issuer for the underlying assets. This entire process can be conveniently integrated on-chain. Abdex's comprehensive infrastructure and rich trading assets allow users to trade not only crypto assets and RWA assets on Abdex, but also purchase passive or active ETFs managed by star managers. At the same time, leveraging the transparency of the blockchain and decentralized voting governance, effective supervision of fund managers can be achieved, and fund managers' permissions can be controlled. In summary, the main features of the Abdex exchange are decentralization, on-chain AS market making order, decentralized real-world assets, and on-chain ETF. Section 4, Profit Model and Token Empowerment. The Abdex blockchain itself can be profitable, and the chain has its own account. The main sources of revenue are as follows. 1. Transaction fees. Users pay transaction fees when obtaining stablecoins and executing trades on the order book exchange. 2. Arbitrage profits. The stablecoin system can obtain arbitrage profits during the process of stabilizing the stablecoin price. 3. Listing fees. If other projects want to issue their tokens on the Abdex exchange for trading, or if fund managers want to open new on-chain funds, they may pay lobbying fees to ensure the on-chain vote passes. 4. Sidechain revenue. Abdex will be developed as an Ethereum sidechain. A portion of the locked assets will be invested in Lido and Aave to generate passive income. 5. Liquidation income. Abdex will impose a certain percentage of penalties on liquidations of users. ABD is the native token of Abdex. Therefore, ABD should be the core embodiment of on-chain value. Holders can use ABD for decentralized trading, governance, proposals, voting, and dividends. ABD holders can obtain dividend rights. After on-chain voting passes, the profits from the chain's account can be distributed. ABD can be used to pay for gas fees. ABD holders can obtain mining rights. As a POS chain, validator nodes need to stake ABD to validate and mine, thereby obtaining gas fees and trading fees. The Abdex chain is also a decentralized autonomous organization. ABD holders can obtain the right to make proposals and vote. Section 5, Future Plans. We have a series of development plans. Our goal is to complete all functions as soon as possible and complete the code audit. Currently, Abdex's MVP chain is available. Welcome to visit the blockchain's web frontend, abdex.fi, for interaction. This is our Abdex project. In our view, finance is the original intention of blockchain and the best application scenario for it. However, we believe that the potential of blockchain in financial applications is far from being fully developed. We believe that everyone can see that Abdex's series of innovations and designs fulfill most of the imaginations people have about decentralized finance, and it has the opportunity to challenge traditional finance with its innovations. If you are interested in Abdex, please feel free to contact us. The principles behind Abdex are relatively complex. If you have relevant interests and ideas, we welcome to discuss with you through online meetings. Thank you.